The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawkbox Europe with Karen Cho and myself, Steve Sedgwick, and these are your headlines. So we've got UK inflation data hitting the wires. The figure is not going to be good news for Rachel Reeves. 3.8% year-on-year headline July inflation. The Reuters poll was for looking for only 3.7% as well. So hopes of interest rate cuts and hopes of lower financing costs for the government as well, well, they look scuppered for now.
AI concerns hit global tech stocks as the White House looks to broaden its push to take equity stakes in companies receiving CHIPS Act funds. Plans for a Ukraine peace deal with security guarantees begin to take shape as President Trump says the UK could provide air support but rules out putting any troops on the ground.
Right, well, we had the inflation data. I'm supposed to be breaking it now. I've already broken it for you. First in business worldwide. 3.8% is the headline figure. We knew it was going to go up. We knew it wasn't going to be perfect. The pound's going up on the back of it, just a tad, because I think, it's not a million miles away, but it is not comfortable reading for anyone who wants to see the UK economy open to lower interest rates as well. And that includes mortgage holders and, of course, the government, which borrows quite a bit of money as well. But the core figure, excluding what some would say all the useful things in life, energy, food, alcohol and tobacco, up 3.8% as opposed to 3.7% expected. I'll give you one or two more bits of data. The ONS says identified minor error. Oh dear, the ONS under a lot of pressure. They don't want to say that at the moment. No impact on headline CPI, though, as well. Okay, and this one's for a certain economist over at UBS as well, because I know that he hates RPI. RPI was also in positive territory, and that one as well coming in a little bit above expectations as well. So let's get to Ritika, who's having a look at numbers. I've given the broad brush. Good morning to you. Good morning, Karen, by the way, as well.
Good
Hello.
morning.
Not comfortable reading.
Not a comfortable reading indeed. So as you mentioned there, rising to 3.8%. The expectation was 3.7% going into this. The drivers, those things like food, energy prices, fuel, CPI services. I also want to highlight that. Of course, services is a dominant part of the economy. That rose to 5%. It was expected to be 4.8%. I will point out, though, there are some idiosyncratic factors that we might want to take into account.
Very brave of you using such a multi-syllabled word so early in the morning. Well played you.
But it is the Oasis concert. So that drove, when we were talking about that in the office, about how many people going, and that is expected to have driven it up. It's kind of like that Taylor Swift effect. So
really? The Liam and Noel effect.
Economists are expecting that could raise it by 4 basis points.
I have to confirm that I was at one of the Wembley Stadium Oasis concerts.
See?
There we go.
And I believe I might have been one of only 5 people sober there.
You've contributed to all of the elements that have lifted off today.
Steve,
there's
it's down
the concert,
to you.
but there's also the airline story, isn't it? The airline ticket spike in the summer months. That seemed to be a contributing factor too.
So it seems to be, you're right, airlines, accommodation, all these factors have driven up this number. But of course, it's going to be worrying for the Chancellor, Rachel Reeves, and also the Bank of England. I mean, they see the upside of risks to inflation at 4%, but we saw how tight that vote was in August with the MPC members. So what does that mean for November?
I don't know if it's just me, but I feel like the consumer has not rolled over yet in the UK. I mean, if you go out in the capital over the weekend, it is still heaving. And it's just extraordinary given all the pressures that we've seen from the Chancellor, all the measures and even more measures being discussed about some sort of raid on property prices as well. When does the consumer start to roll over with higher inflation and all the tax pressures?
When they lose their jobs.
Yeah.
That's the answer.
We had that GDP data last week was actually better than expected. So it's hard, isn't it, reading? There's mixed pictures from the data, so that's why it's really hard for policymakers and people like you and I to pass through the numbers.
Indeed, and spend money on overpriced T-shirts for your teenage daughter at the aforementioned Oasis concert. Thank you. Let's get to James Sproul, Chief UK Economist at Handelsbanken. James, key question. I presume you weren't at the Oasis concert?
I was not. I was not contributing to inflation in that particular way.
OK, we've got that over and done with. That's the key news. What else do you think about these figures at the moment, sir?
Well, a couple things. First of all, I was pretty I'm annoyed about the services inflation. It's looking really sticky. And given the importance of services to the UK economy, I look at that and think, if the MPC is looking at this as well, I'm sure that they are, the chances of a rate cut in November are vanishingly small. We'll obviously have some more data out before then, but at the same time, we at Handelsbanken have been saying for some time, actually, inflation's a bit stickier than people are expecting. Don't expect it to be falling as quickly. Don't expect the MPC to be cutting as quickly as many in the market are expecting as well. So I wasn't particularly surprised by today's data, and I'm not going to be changing my forecast for when we expect the next rate cut. We're looking for 25 basis points in December, but if the data keeps on coming through this strongly, even that starts to look more doubtful.
Oh, James, I wanted to ask you about the impact of the national insurance contribution on services. Is that the feed through from fiscal policy to monetary policy effect, where the high pressure that we've seen some of the labour market facing with the national insurance contribution, but also the high minimum wage, is that just getting passed through on the services side?
I think those two things are in fact absolutely correct. And I think that also we're dealing with one of the things that people do all the time is they sit there and they say, well, look, inflation has been, as we're just seeing, 3.8% for the past year. But actual consumers don't look at just the last 12 months. They're looking back over the last 3 or 4 years, and they're thinking, gosh, prices have gone up a long way over that period of time. And they're reflecting that in the sort of wage demands that we're seeing coming through as well. And so I think that there's one of the reasons we look at that inflation being sticky is because it's been quite a bit higher, not as high as, quite a bit higher than it is today. But the fact is, consumers aren't just looking at 12 months. They're looking at a longer period of time. And there's a lot of pressure on that. The national living wage rise, 6.7%. It's a big rise for less well-paid workers. The other thing that's going to be happening, of course, is we don't know the full details of it, but the Employment Rights Act going to probably come through this autumn. That's also going to add to some of the stickiness to wages, and probably I think it's in fact one of the things we're doing is raising our long-term level of unemployment in the UK on the back of both the national living wage and this Employment Rights Act.
Yeah, James, there's a lot to break down in what you just said. I'll go through one or two of those elements. Look, nobody minds, in traditional economics, no one minds. In fact, it's a positive if in a service-based economy, in a consumer-based economy, that employee wages go up and remain sticky. Yep. If productivity is improving as well, and that is the holy grail, which has eluded many governments for many years as well. Productivity in the UK, the government has set its store out on growth and productivity. Any sign of improvement on productivity?
I wish I could say that there was, and I completely agree with you on this. Yeah, productivity has been languishing. Productivity in certain parts of, for instance, the public sector, really looking pretty poor indeed. And that's an enormous challenge right now. And I have not seen it getting better. And therefore, a lot of these pay rises right now, you just think you shouldn't be measuring it from zero. You should be measuring it from where's productivity moved from. And so if productivity in some cases is negative, that's an even bigger pay rise for people and really less justifiable.
James, let me bring in tariffs to the conversation, because you've seen a lot of twisting and turning from manufacturers globally trying to keep a lid on prices to sell into the United States, and obviously waiting it out for more information on where the retaliatory tariffs first up to the actual baseline tariffs would end up. But the reality is some companies are now looking at spreading the pain across various countries, not just leaving it contained to the United States. What do you make of goods inflation also coming back into the basket in the UK?
Well, I think that a lot of companies, of course, they're very, very competitive and they wanted to maintain their market share. And so for the moment, because there's a great deal of uncertainty, both with Trump's tariff regime, they're probably willing to take a little bit of a hit on the margin. The other thing that's, of course, skewing that trade picture has been that there was a lot of front loading of it. So people anticipated the tariffs and they pushed a lot of goods into the US as fast as they could. And they're still running down that stock. So I don't think we're seeing a clean picture on that just yet. Over time, as the markets settle down, we're going to see just what's happening. The other issue, of course, for the UK is that our main exports to the US are not goods. Clearly, we've got some important goods that go there, autos, for instance. But at the same time, it's mostly services. Those aren't subject to those tariffs. And so I think that the UK probably maintains a pretty good competitive position in terms of trade with the US, even with all of Trump's tariffs.
James, can you do us a favour? Can you hang on for a moment? Because I want to do another read on a story which I'm hoping you've got a view on as well. In fact, I know you'll have a view on this as well. So we'll come back to you in literally 1 minute's time, because UK Chancellor of the Exchequer, Rachel Reeves, is reportedly looking at removing the capital gains tax exemption on property sales. Now, above a certain price threshold. I should caveat that. This is primary property sales. This is not investment property. This is your first home. That makes a big difference. According to London Times, and I've seen it in the FT as well, which says higher rate income tax payers would have to pay a levy of as much as 24% on any gain they make on their increase in the primary residence's value. This as the Treasury looks to fill a hole which is oscillating, but estimated to be somewhere in the region of £20 billion at the moment ahead of this autumn's budget. James Sproul, of course, still with us from Handelsbank. James, I can't help thinking that this kind of story is put out there to so-called fly a kite, to test the water, to see what kind of reaction it gets. I mean, governments do it, companies do it as well. But if they do start taxing on primary property to get themselves out of a mess, basically, what do you think your reaction is to this? And could it have big negative ramifications, or is it just for a certain part of the population that's going to affect?
Well, I think three things. First of all, I completely agree with you. I think it's flying a kite to see how it goes. I think there's also a little bit of scaring the horses here in terms of, when the actual policy comes through, it's unlikely to be as dramatic as what we're seeing here. The way that we tend to look at property prices is people look at them in terms of affordability, look at people's incomes, look at the property price. That's one way, and it's very good and it's valuable. The other way to look at it is look at yield. And therefore, property typically yields about 4% more than a gilt. If you take down the amount of return that a property gives you, the price has to adjust. And so we can see relatively small adjustments, for instance, whether in council tax or whether in property taxes you're mentioning here, which are going to reduce the amount of income that a property will generate, and therefore that will be reflected back in prices. And you're playing with fire here. This could be very, very dangerous. You're going to see a much bigger impact on property prices than you expect through this removal. This has been a long-standing thing with property prices in the UK. I do not think it'll be received well. And finally, of course, it's not just a few people at the top. It's actually going to largely be London and the South East. So it's going to really, really hit, frankly, an extremely important part of the country economically.
James, show me a property in London that's worth less than $500,000, and also keep in mind property prices haven't gone anywhere in London for a while. The idea here was to put the pressure on landlords again, not tenants, which I thought was just incredible, given landlords seem to be evaporating very quickly thanks to all the taxation to date and the high transaction costs that have been lobbed in the form of extra stamp duty so far. If we tackle the landlords yet again, what does that mean in terms of rental stock? And what that means for inflation down the track if there are fewer properties to rent? Surely that means higher rental prices.
It certainly does. And we've seen that again and again, whether you have rent controls and direct, landlords are not allowed to charge more than X amount of rent, or whether you burden them with all sorts of extra costs, the effect is the same, which is to reduce the stock. Now, there are always going to be people who want to rent properties because maybe they're only coming to London or a particular town for a couple of years. It's not worthwhile buying, etc. So there's really genuine reasons why people need rental properties. You need a vibrant rental sector. And right now, it's looking a little bit endangered because we're seeing a lot of small-time landlords just leave the market. It's leaving it only to professional landlords. That's fine. In terms of professional landlords can be very good, but it probably need a deeper market than they alone are able to provide.
James, how about this one? I know I'm particularly dumb at many aspects of economics, despite having looked at it for my entire career. But I want to just give you two scenarios. Buyer one, and this is for Rachel Reeves, really, not for you. Someone buys a house for $1 million and sells it for $1.5 million. So, in theory, they're being taxed on 50% profit. But buyer two buys a house for £500,000 and sells that house for $1.5 million, but spends £750,000 improving that property. So they've got a cost. How can that person, buyer two, be taxed more than buyer one because their profit is greater, despite the fact that they've used capex to actually improve that property? It's nuts, isn't it?
Well, of course, if you're a business, you'd be able to write off a lot of that and it will be treated very differently. But you're absolutely right. And the devil will be in the detail on a lot of this. What will happen? In past the Treasury, of course, right now we're also having buyer one and buyer two buying these various places, and inflation pushing up the price of the house, and you're essentially being taxed on the inflation, even if the real value hasn't gone up very much at all. So again, there's lots of anomalies coming into this market, and people are going to get pretty aggrieved about it all. And I think, I don't envy Rachel Reeves' job at all, because she's in a really, really difficult place between lots of pressure from her own backbenchers, lots of pressure to spend more money on the health service, and then a tax system, which she inherited was at a very high level, and she's taking it to an even higher level. This is going to be causing lots of pain for people.
So many disincentives, James. Can I also ask about financial stability as a broader theme when it comes to all these property taxes, not just in the UK, but we're seeing it elsewhere? The reality is we've got a population that has been asked to work longer, having more saved into retirement, so they're less of a burden on society and state coffers. But that money seems to be pushed effectively into the stock market, because if you take away a lot of the incentives of owning property, it leaves almost one asset class, and that's really stocks, equities. Doesn't that provide some form of market risk, financial stability risk, if there is a stock market that tanks like the financial crisis and takes 10 years to recover?
It certainly does. And I'm old enough to remember way back in the 1990s when we actually opened up people's SIPs to put in property into that, because we wanted them to diversify out of that. Obviously, subsequent governments have changed their mind a bit on all this. I think you're pointing to a really, really important thing in terms of financial stability. One of the things that we're looking at a lot is not just inflation, because that's clearly important. That's what we're covering this morning, but also what's going on in the longer term. What's the thing that's going to be driving people this autumn and markets this autumn? I think it's going to a lot be the long bond. And that long bond is not just looking at inflation, it's looking at inflation and the government's own finances. And there's some big questions. How are you actually going to put UK, but the same goes for the French, same goes for the Canadians, same goes for other countries as well. How are you going to put these things on a stable, long-term footing? And right now, that's a big question. And I think it's going to become increasingly important over the course of the next few months.
James, I've loved everything about this interview and your brilliant commentary until the last comment where you said, I'm old enough to remember the 1990s. When did we start saying that? Surely it's, I'm old enough to remember the 80s or the 70s. Don't age you and me, James. Don't do that, sir. Old enough to remember the 1990s. It still feels like yesterday.
Well, old enough to remember the policies of that period of time.
Oh, I remember it very well. Yeah, we both remember the poll tax. That was interesting. James, lovely to see you. Thank you very much indeed for joining us. James Spruill, Chief UK Economist at Handelsbank. I remember the night of the poll tax protest. Me and my partner were going through to the theatre. We were walking in our finery, as you used to do in those days, to the theatre amidst a pitched riot in Trafalgar Square. Not joking, buildings were on fire, horse baton charges, protesters fighting aggressively, and me and my partner at the time just walking through the whole thing, oblivious.
I mean, I'm just alarmed. I was really stunned with, if you can remember public policy from the 90s, then you're old. So that's a bit of a problem, given I was covering public policy then.
I remember the strike in 76 or whatever it was. I remember the blackouts.
Yeah, I mean, I was just going, if you remember policy from the 70s, then you're old. But the 90s is alarming.
Yeah, you can't do that.
Coming up on the show, US Commerce Secretary Howard Lutnick confirms the government is looking to take a stake in Intel in return for key funding. Details next. We're also going to dive into the soap opera of European banking M&A when Sylvia joins us later this hour. And Trump rules out US boots on the ground in post-war Ukraine, floating other types of support. We'll bring you Tanya's interview with the former UK Foreign Secretary on the state of play in Ukraine. The market leaders are becoming market losers today as some of the big hype caught up with the market action, in particular around technology. And don't forget, $4 trillion market cap for Nvidia of late has not been a concern for markets, really just counting down to the big event of Nvidia numbers. But it was a problem yesterday as investors took stock of the rally we've seen across the board and pulled back on some of the big tech names. When I mentioned market leaders too, the likes of Goldman Sachs also under pressure yesterday. It's been one of the market leaders up there with Nvidia. May not be a tech company, but leaders were truly under pressure yesterday. And you could see across the board some of the big tech names. These are AI names, and you're looking at the AI leaders from Nvidia to Meta to Microsoft and Alphabet. Obviously split performance in terms of the size of the pullback. Concentration of selling around Nvidia, as you can see. To the chip makers, a lot of talk about stake ownerships by the government, Intel in particular, whether that has stretched beyond Intel to other companies involved in taking grants. That also was another lurking theme there for some of those big US chip stocks. And you can see in the basket, Qualcomm We're not talking about a stake ownership of the government here, but we are talking about what it could mean as a rival to Qualcomm that has been advancing on Intel territory, down 1.7%, ARM down a fairly strong 5%, and Broadcom reversing too, so knocking the Philadelphia Semiconductor Index. A look at some of the Asian tech stocks. Not immune. I think you've seen tech trade in lockstep, and that is across the global equity market. So in action today, SoftBank down heavily. There's a sell-off to the tune of 7+%. I mean, when these stocks move aggressively, they do, and that is in both directions. Now, TSMC down more than 4%. And as we talk about those government stake ownerships, it has been swirling for the implications around this Taiwanese company. Steve.
Yeah, there's a lot to break down there. We'll try and cover most of that over the next 2 hours and 40 minutes. US Commerce Secretary Howard Lutnick has confirmed to this very channel that the US government is looking to take a stake in Intel in return for CHIPS Act funding. Lutnick said that any potential agreement would not provide the administration with voting or governance rights. OK. Speaking to CNBC, Lutnick explained the thinking behind the administration's equity demand.
America should get the benefit of the bargain. I mean, that is exactly Donald Trump's perspective, which is, why are we giving a company worth $100 billion this kind of money? What is in it for the American taxpayer? And the answer Donald Trump has is, we should get an equity stake for our money. So we'll deliver the money, which was already committed under the Biden administration. We'll get equity in return for it, get a good return for the American taxpayer, instead of just giving grants away.
Really? Is that how it... Oh, I'm sorry. I didn't watch the interview. I'm hoping our US anchors push back on that one. America gets something back in return for grants, sir. America gets jobs back. It gets taxation revenues when the company makes a profit. It gets profit in terms of tax. It gets the jobs. It gets the growth. It gets the regional... resuscitation in areas that have been deprived as well. That's the whole point of grants. Not that you get a slice of the action as a shareholder. You get it back because you're creating benefits for the community, for growth, for the employees of that company.
Yeah, and multiple different touch points on taxation, from corporation tax to labour tax and every other tax comes with it.
Action? I don't understand
the slight
this change.
difference in policy this time round is, if you see some sort of bailout or stake ownership, it typically came in collapse or bankruptcy moment. Now it comes at a point where these companies have been trading stronger on the back of a big thematic being AI. Intel, obviously, a slightly different story because it's encountered some problems. But if we talk about other companies, would the stake ownership come at a fairly strong trading price? So there would be a natural gain at any point down the track if there were to be a sale. Anyway, we can debate it more about it.
It's complicated because if you're a shareholder, what does that mean about government contracts? What does that mean about those who are getting CHIPS Act grants who haven't got an equity holding? It creates all kinds of moral ambiguity and opacity in the relationship between that company and indeed the government.
I think it impacts the orders, but we're going to get to Arjun on this in a minute. But meantime, more around this story, as Lutnick also suggested the president could seek similar deals with other chip recipients. Micron, TSMC and Samsung, some of these not being American companies, have all been awarded money under the legislation, but much of the funding has not yet been dispersed. Separately, Reuters reports that Lutnick is driving the process to take equity stakes, but Treasury Secretary Scott Bessent is also involved. Shares of key US tech stocks sold off in yesterday's session amid negative commentary around AI and concerns that the massive hype could be overdone. A report by the Massachusetts Institute of Technology suggested that just 5% of AI pilots were extracting millions in value, while the vast majority showed no measurable financial impact. It comes just days after the OpenAI CEO Sam Altman signaled that an AI bubble is forming. Well, let's get to Arjun on some of these. And let's tackle the CHIPS Act and how this could be now transitioned into some sort of equity stake. I mean, for the likes of TSMC, I know that the Taiwanese government was trying to play a straight bat today and not attract any attention from the president. But these are foreign companies with private investors in many cases. To just simply have this turned into some sort of American stake, what sort of precedent does it set?
Yeah, I mean, geopolitically, we know how important semiconductors have become and how incredibly strategic they are to many governments, and that includes the governments of Taiwan and South Korea as well. When you look at what South Korea has been doing with semiconductors, they've been trying to really push on their own domestic supply chain, from Samsung, SK Hynix, the ability to have those memory companies, to the manufacturing, and some of those other AI software companies around. They're trying to build this whole sort of supply chain around artificial intelligence, and I don't think they're going to be happy with any kind of government stake, nor I think Taiwan and TSMC either.
What jumps to mind is the conversation from Mario Draghi and Enrique Letta about the playing field and how it's changed, that the US and China are not playing by fair rules, typical rules of the past. And this is another example, isn't it? Because the Intel story about the grants was designed to counteract TSMC. The Taiwanese company had to find their way back into the action by coming up with a truckload of money to build factories themselves in the United States. So now what are we talking about? Beefed up competition from rival Intel, with perhaps orders falling in line around Trump policy because no one wants to, again, attract the eye of the president, so they order more Intel product at the expense maybe of TSMC. But then what, the government also angles for a stake in TSMC? What part of that is fair?
Yeah, I think the Intel story is going to be an interesting one because they've had a lot of money. They've tried very, very hard to bring the foundry business anywhere near competitive to both Samsung and TSMC, and it just hasn't happened. And I don't know 100% if money is necessarily the answer. Perhaps there is a lack of technology prowess versus some of these other companies, and the fact that TSMC has such a long-standing relationship with Apple, Nvidia, and all these major players who need their chips manufactured by TSMC. The reason they haven't gone to Intel is Intel just doesn't have the technology to do so, and I don't necessarily know if a government stake or a truckload more money is going to solve that problem, at least in the short term. To catch up when it comes to manufacturing of semiconductors, takes a very, very long time. To build new fabs, to get the technology required, takes a long time. It's the reason China hasn't been able to do it. It's the reason Intel still hasn't been able to do it. So I don't necessarily know if this changes the game in terms of Intel being able to catch up technologically. If it does, then that's where we get to the point where the US government could do what you said and push Nvidia, Apple, and others to get their product manufactured by Intel. But I still think there is a technology gap here which is going to be hard to overcome.
Well, this is the point. If you want to sit back and say, well, it's not fair, but hey, it's great for America, I would argue that it's also not, because if you look at how innovation has won out, the US has had to be so competitive for so many years, and this is where it has trumped innovation elsewhere. We've been talking to Qualcomm, for instance, about their inroads into this space, into PC and into servers, to the point where Intel is scrambling to try and protect its market share. If you start putting government intervention everywhere and then orders get impacted, I better order some Intel product to keep the US president happy, but it's not the best innovation, but I better make the order anyway. Where does that leave innovation in the US at what is a crucial period as the Chinese are trying to out-innovate the US?
Yeah, you speak to anyone in Silicon Valley and they'll say that the reason, or one of the big reasons US tech has been so successful is because of that lack of government intervention over the past sort of decade or 2 decades. And so that is something that investors as well as the companies themselves don't like. Regulation aside, it's the fact that the government just haven't been involved. You look over in China, conversely, they've been heavily involved in the country's semiconductor sector for a very, very long time, for at least 2 decades, and thrown loads of money at it, but still haven't been able to compete with what the US is.
You say last couple of decades, I'd argue last 50 years, but we can split the difference on this one, and it's the private sector, not the public sector, which, as we're all saying, has been the driver. We keep flashing aboard with AI plays as well. I just want to revisit this very quickly as well, because I have a problem with treasury, Bitcoin, crypto treasury as a strategy. Well, we can talk about this ad infinitum another time, but basically it means if you are a company that does X for a living, let's say you're a coder or your software or whatever you do, if you buy a load of Bitcoin and put it on your treasury, then you get a multiple of the valuation of that of your company previously, but also of the value of that crypto, because people think you've got an acquisitive strategy on crypto. It's nuts. But MicroStrategy is the biggest winner of this one, has been for a long time. Everyone's mimicking it now. On days like yesterday, it seems a little bit tricky.
Yeah, it's tough. I mean, like, we had a huge sell-off across tech. There are concerns around this AI trade. I think 3 things: valuation, there is that AI trade that's being questioned, and the geopolitics that we're talking about here is all thrown uncertainty in the market. For the crypto trade, look, we've seen that continue to be linked to the tech trade still. It hasn't necessarily decoupled as many sort of thought it would at this point.
It's recoupled because people are now saying, I do this as my company, but if I own crypto and put it on my balance sheet, my multiple of my company will trade exponentially as well, which in itself I find an extraordinary strategy.
Mind-blowing.
Mind-blowing.
Yeah. And there are new
And they're doing it on leverage, or very often, or they're saying they're doing it but not doing it as well, which is even more torturous.
Yeah, I don't know how. I mean, MicroStrategy was the OG, the original company that
and they've made lots of money doing so.
Lots of money doing so, and it's difficult because when the market moves, then these companies are there moving too with it.